Hello and welcome to SwitzerTV Property. I'm Peter Switzer. And this week he's back, and like the Terminator, Joye is exterminating property market bears, showing that current real estate prices are defying gravity and the doomsday merchant's predictions. And he's saying when it comes to a house price recovery, you ain't seen nothing yet. Joining in on the positivity for property is the founder of buyers.com.au, Peter Warsham, who says both the statistical and anecdotal evidence says you should forget about a property price slump. And then we talk to the CEO of the Master Builders Association, Danita Warren, who thinks the budget will help underpin a gradual improvement in building starts, but it won't happen overnight, with a lack of immigration seen as one of the big threats to the industry. Interestingly, Joye has a more positive view on the chances for a resurgence in immigration. That's the show ahead, so let's kick off with the always controversial and very confident Joye from Coolabah Capital. Joining us now to look at the problem for housing property bears, who he thinks they're going into extinction, is Joye from Coolabah Capital and the AFR. Chris, thanks for joining us.
Thank you for having me, Peter.
All right, so your latest take on house prices is telling you that all those doomsday scenario merchants out there are going to be wrong when it comes to house prices?
Well, you know, in March, mate, we forecast nationally prices would fall by at most 0 to negative 5%. And since that time, they've fallen 2.8%. We were quite ferociously attacked at that time for that that comparatively positive view. And the consensus was that house prices would fall 10%, 15, 20, 30%. All the major banks, all the investment banks felt that way. We argued that the correction would only last about 6 months and that the market would start turning around September. And that's exactly what we've seen. So I might just screen share a chart quickly.
Yep.
Is on the left-hand side, the daily house price movements across different cities. And on the right-hand side, we can see the changes in the month of September. So we've actually seen now, firstly, the first smallest loss that we've had since the market nationally started rolling over in May. So nationally, across the 8 capital cities, house prices only fell 0.2% in September. But we actually saw house price gains in Perth, Canberra, Hobart, across all regional non-metro markets in Brisbane, Adelaide and Darwin. Now, I want to show you the even more recent data from CoreLogic because it's absolutely fascinating. These are Sydney house prices right now. So this is through to October. And you can see Sydney house prices have really started flatlining in September and October after they increased over the first quarter, and they really rolled over in circa May. And we see the same phenomenon, actually a more bullish phenomenon in cities like, for example, here in, can you see this Perth chart,
Yep,
Peter?
we can. We got that.
Yeah, so this is January through to, again, April. House prices roll over, and you can see them starting to increase in Perth. And then if I go to, here, Brisbane, these are Brisbane prices, same phenomenon. So increasing over the first quarter, rolling over in May through to August, and then increasing in September. And then finally in Adelaide, here you can see prices increasing in the first quarter, rolling over, and then starting to rise again. So our forecast, Peter, was a 0 to negative 5% decline. And then crucially, post-September, we argued house prices would rise by 10 to 20% over the next few years. What's important is the bears have started to discard their preternaturally pessimistic projections. And we've actually seen CBA drop its 10% house price forecast, Westpac drop its forecast. They're both now forecasting house price rises in 2021. Westpac is saying house prices could increase by 15%. That's in the middle of our 10 to 20% range. CBA is saying that they'll start increasing next year. Goldman Sachs are saying they're going to start increasing next year. So the bears are dropping like flies. There's absolutely no doubt about that, Peter.
And of course, the numbers could even be better nationally if Melbourne hadn't gone through a second lockdown.
That's right. I mean, as you know, in March, we said that the first wave would peak in early April, and that's what we saw in Australia, in Western Europe, and in the US. So the first waves really peaked in early April. That was also a very contrarian view in March, because we were being told that the first wave would potentially last up to 6 months. But the second wave in Melbourne was a big surprise to us. We did project that it would peak in late July, and it did peak around, I think, the 31st of July. But that was an artifact of policy-making errors. It was clear that Dan Andrews' government unfortunately made some pretty heinous management mistakes, and that was an entirely unnecessary second wave. That was 99% of the infections were attributable to the quarantine process. Yep. So were it not for that second wave in Victoria, we would see an even more buoyant and ebullient housing market. But it's in the data. The auction clearance rates are very strong. In Sydney, the preliminary numbers have been punching above 70%. Nationally, they've been above average. We are seeing, again, we expected this. We've been arguing that we'll see strong offshore buying from both expats, but also from Asians looking to effectively hedge political risk. And we've argued that we'll see buying from Hong Kong, from Taiwan, from mainland China. You might have read a couple of weekends ago, there was a property that went to auction with a $14 million reserve. It sold for $24.6 million at auction. That's an Australian record. There were a Chinese buyer. There were 25 contracts. Allegedly, 22 of the 25 contracts were Chinese buyers. So whilst Treasury is forecasting really weak population growth, Peter, yep, we're actually, again, we've got a contrarian view on this. We are expecting strong net overseas migration, or a recovery, I should say, in net overseas migration over the next couple of years. And we think the government will wage a war for global talent. And we think Frydenberg and Morrison will really try and attract the best global brains to Australia, and also capital. They've already offered 5-year residency visas to every Hong Kong student currently living in Australia. And we think we'll see very strong offshore demand.
And so, given what you said about immigration, you must be doing some work on the likelihood that we'll see a vaccine maybe by the end of the year?
Yeah, again, since February, we've argued that we'd get a vaccine this year. The vaccine would be effective, and that mass distribution would start this year. That was a hugely heterodox view. No one kind of had the same view. Everyone sort of argued it would be minimum 18 months. We know that Pfizer will finish its phase 3 trial in October, or at least finish it will release the first round of results from the phase 3 trial. Moderna and Pfizer and also the Oxford vaccine have already started mass production. So Moderna's already mass producing their vaccine at 3 different facilities in the US. So we may not get vaccines distributed on a mass market basis this year, but I think vaccines will be approved by the FDA for emergency use this year. And I think we'll see the Pfizer vaccine hopefully approved. And if not this year, very early next year. And we'll definitely see mass production early next year, which I think will be positive for the market. But coming back to housing, I just want to talk about this, Peter. I mean, there's so many different drivers that are, I think, fueling the sanguine sentiment in the housing sector. So I just want to run through them. We've seen mortgage rates, fixed rate mortgages fall 150 basis points. As you would know, in April last year, we were the first analysts in the market to say house prices were falling in April nationally. They'd fallen 10%. We forecast that in 2017. In April, I wrote in the RFR, the bust is over and we're going to get a 10% jump in prices. And that's exactly what we got between April last year or June last year and April this year. But since that time, the RBA has cut the cash rate from 150 basis points to 25 basis points. We think the RBA will cut again in November from 25 to 10. And we think the RBA will ramp up quantitative easing or purchasing of bonds. But mortgage rates have fallen about 150 basis points for fixed rate loans. So you've seen a huge increase in purchasing power. At the same time, you've actually had a positive income shock for households because we've had one of the biggest fiscal stimulus programs of any government globally. The jobless rate, we argued in March, would settle quickly at 6 to 7%. Right now, it's 6.8%. It's defied, all of the universally much more pessimistic projections. And then we're also seeing other sort of positive developments. So the government has proposed to repeal the responsible lending laws, which we've argued since 2018 should be removed because they shift legal liability for repaying a loan from the borrower to the lender, which is absolute madness. And the government, obviously, again, in the budget announced 10,000 new first home buyer guarantees. So they're going to guarantee the deposit for first home buyers. And then finally, we've got positive gearing. You can get gross rental yields in most Australian cities around 5% on apartments, and your mortgage repayments are 2.5%. So we've talked for decades about negative gearing. Well, now you can positively gear. And if you compare a 5% gross rental yield to a 0.8% 12-month TD rate, it's going to be, I think, a natural reflex for many mum and dad investors.
All right. Now, about 3 or 4 months ago, Michael Knox from Morgans wrote that if a vaccine shows up with all the stimulus and the rate cuts and whatever, we could be looking at a rerun of the 20th century roaring 20s. Are you subscribing to that view that we could actually see a very strong 2021 rolling into 2022?
We certainly argued in March that our view was, in late February, I wrote in the AFR that the COVID-19 crisis would create market failures in March. And that's what we got. But our argument, the corollary of that was we would get the mother of all quantitative easing, central bank liquidity, and fiscal stimulus responses. Because it really was a 1 in 100 year shock. And there's absolutely, emphatically, a very rational case for governments to try and provide that liquidity and stimulus bridge between now and when the world returns back to normal, hopefully when we get effective vaccines, if indeed that's what transpires. Our argument in March was we would likely see a speculative melt up, and we would get assets like equity beta perform. In our market, I run about $6 billion, $6.1 billion of bonds, and I spent $1 billion in March buying, basically, mostly buying. I think about $900 million buying and about $100 million selling in March. So credit spreads blew out to all-time highs. Major bank hybrid spreads were the credit spread they pay above the bank bill rate blew out to about 840 basis points or 8.4%. In the GFC, they only got to about 5.9%. So it was an all-time record increase in hybrid spreads. And we've actually earned on those securities, on those individual securities that we bought at the wides in March, around the 20th of March, returns of upwards of 26%. But I do feel, I've got to say, pretty sanguine about the sort of 1 to 2 year outlook for the global economy, for Australia, particularly high commodity prices. I mean, Australia's COVID-19 management has been absolutely world-class. We've got a good chance to eradicate the virus, I think, across the country. And I think housing is going to be the key beneficiary through lower mortgage rates, through boosts to incomes. Yes, the unemployment rate is a bit elevated at 6.8%. And yes, 9% of all residential mortgage borrowers are on repayment holidays. That's an important point. But I think that they'll get worked out over time. I think that number will come down quite quickly over the next circa 1 to 2 years. I do think we'll land with structurally higher default rates. So pre-COVID, the 90-day arrears rate for the 4 major banks was probably around about 0.7%. It's probably going to land around 1 to 2%. So I think we'll have this tail. But I think in the scheme of things for the $6 trillion plus housing market, it won't be especially meaningful. I think you're really going to see a surge in housing demand across the board. I think the investor market will come back. The apartment market is still quite weak. The detached house market is where all the strength is right now. But with positive gearing, I think you'll see the investment market come back online.
Chris Joye, thanks for joining us.
Thanks.
Well, we're continually trying to work out what's happening to the housing market with a recession and a pandemic and Victoria being closed down because of all those issues. But the housing market just seems to be strong. It's not capitulating like the doomsday scenario merchants would really want it to do. So let's just find out what's going on from someone operating at the coalface, Pete Wargent, who's the CEO of Buyers. Thanks for joining us, Pete.
Pleasure, cheers.
Tell us about Buyers. It sounds like someone had got a bit of a repetition problem there, mate.
Yeah, so we actually have a property buying service that we operate nationwide. And we've actually started using the name buyers.com.au simply because, as you say, you can get mixed up with antiques dealers and who knows what else. But we offer affordable property buying service right across the country. So it's something a bit different from the traditional buyer's agency.
Okay, so you're a buyer's agent. Is it done online, or online is just used to get the clients in, and you do it face to face?
Yeah, that's right. Whenever it's possible to inspect a property, we'd always recommend that, especially in the digital age. You never know what property listing might be hiding. So we have a national panel of buyers agents covering every state and territory, and we act as the aggregator for the industry. And because we do it nationally, we can offer more attractive prices. And the other thing we do a bit differently, instead of only offering the very expensive full service, we also offer what we call the We Buy service, which is really just based on the due diligence, negotiation and acquisition process. So as a result, much cheaper than the traditional full service buyers agency.
Okay, so how long have you been going, and what kind of reach do you have over the property market?
So I've been working in the industry myself for over a decade. We started up in London, as you can hear. We started up in Sydney in 2011, and more recently, we've been in Queensland for 5 or 6 years. Buyers.com.au, well, that's a relatively new business. We're going through a large capital raising at the moment, which is keeping us busy. And we've got coverage right the way across, as I say, every state and territory. Traditionally, buyers agencies very largely focused on Sydney, Melbourne and Southeast Queensland, but we want to make those services available across the country.
All right, so one of the things that grabbed my attention was the fact that you thought that the information you're getting around loan repayments deferrals was kind of telling you something about a housing market rebound in 2021. Talk us through it, Pete.
Yeah, so the mortgage deferrals is an interesting one because, as you rightly pointed out, there is always, and I do mean always, a doomsday scenario out there. And this is an issue which we've still, even at this point, we've still got about 9% of resi loans on deferral. It's very, very high. I mean, traditionally, 1 to 2% in arrears would be typical for a loan book, and maybe 2 to 3% in a state like Western Australia that's been in a recessionary condition for some time. So 9% is an extremely elevated number, of course, but it's a pretty unusual situation. A lot of the feedback we've been getting via mortgage brokers is that a lot of people took mortgage deferrals as an insurance policy earlier in the year when there was a great deal of uncertainty, and people thought, well, let's take that opportunity. The numbers are gradually coming down, but I think the other thing to take into account is when you get these known risks that months ahead of time, they very rarely blow up into the big issue that people expect they will. I mean, the best analogy in Australian housing would be the interest-only time bomb, which attracted all of the headlines. Now, the peak of interest-only lending was 2015, so 5 years beyond that, 2020 was the year it was supposed to all blow up. But of course, when you get these known risks, solutions are found. The regulators were well aware of the issue. And of course, 2020, nobody's talking about interest-only lending because the numbers resolved themselves. So I think we'll see in this environment a very similar outcome here. The regulators know that they need to get banks and lenders to work with any stressed borrowers to help them through. But also lenders can now make interest-only products available again from, say, 2.5%. So there's very few stressed borrowers out there compared to what you might expect to see in a normal recession.
Yeah, it's funny you bring up the interest-only time bomb. On my Sky Business TV program over that period of time, I kept questioning, how stupid the regulators would be to allow that kind of thing to happen. But no, end of arguments would never be accepted by some very, very smart people who today, I guess because of Google, we actually can remind them of how stupid they were. But anyway, that's me just thinking out loud. You brought up the issue of mortgage stress, and there are people out there who try to calculate the level of mortgage stress and then extrapolate about what's going to happen. Do you have a view on the reliability of mortgage stress data?
Well, yeah, I mean, we've got a de facto measure of mortgage stress, and that's simply 30-day loan arrears, and it's fairly timely data. So I'm always a bit sceptical of household surveys that are extrapolated from a relatively small number across the country. I think in terms of criteria as well, if you're basing mortgage stress on household cash flows, well, we've got a very unusual situation in Australia, and it's definitely changed over recent years, and that's because of the use of mortgage offset accounts and redraw facilities. It makes perfect sense in a low interest rate environment for people to accelerate repayments or park money in the offset. So I think it's actually very common to see households with a sort of an outflow of cash, if you like. It doesn't necessarily indicate stress. I mean, if you look at the RBA numbers on mortgage prepayments, they're through the roof over the past 5 years. So I think in aggregate, mortgage stress is no higher than, well, you can see the mortgage stress numbers in 30-day arrears. They've gone nowhere until the pandemic. So I think at the margin, though, there may have been some issues, but we've seen 5 rate cuts in 12 months. That tends to take the heat off.
Yeah, and I think another point to make, Peter, is that if you look at our household debt to GDP numbers, which are worryingly high on international standards, those numbers never ever deduct that buffer of all those payments or prepayments people have made, which are buried in their offset accounts or whatever, which really means that the net figure would be a lot lower than the gross figure that's often quoted.
Well, yeah, I mean, in fact, if you actually run the numbers via the RBA stats, net of prepayments, debt to GDP has really, it's almost gone nowhere in 15 years. It's at the gross level, debt to GDP, the last count is about 1.9. Sorry, household debt to disposable income is about 1.9 times. But you net off those prepayments, and it's really gone nowhere in 15 years. The other thing to take into account is just the serviceability, because sadly we would be old enough to remember double-digit mortgage rates, and when you can borrow today for new borrowers at we've got a dozen lenders now at under 2%, but even for the typical borrower, somewhere in the 2 to 3% range. Well, interest rate serviceability now is back to where it was in the late 1980s. So, I mean, you can talk about debt to GDP and mortgage stress, but for most incumbent borrowers, life has become relatively easy, much as that's not a popular opinion.
Yeah. What about the situation for home units? The generalisation that the property market won't have a terrible experience. Is the specific position of the unit market in a more precarious position than, say, homes?
Yes, it's a bit of a granular situation. I mean, generally speaking, the unit market in the most mature capital city, i.e. Sydney, is holding up relatively well. I think, that's just a global thing. You find in the more mature capital cities, higher density living is more commonly accepted and even desirable in many cases. But I think if you look at the situation this year, it's pretty unusual. There's 2 parts to that. There's a structural element, and it's the inherent scarcity of family appropriate housing. There tends to be that structural undersupply. But in a global pandemic, people are naturally eschewing density this year. Plus, we've got the issue with fewer international students and Airbnb issues. So I think in particular, we do a lot of work with Riskwise property research on housing supply, and they've identified a number of areas of Sydney with even now a lot of units in the pipeline and not much demand for them. And the same is true in Melbourne, CBD and Docklands. Sydney has a few hotspots as well, though.
Pete, when it comes to the stock market, I often will say to people, if you see a quality company that's actually being trashed by the market, and it might not be for any real reason, that maybe the sector's out of popularity, there's a rotation out of, say, one sector into another. If we look at, say, for example, the position of a lot of home units in Sydney and Melbourne and Brisbane to a certain extent, because of a lack of students, because of a lack of foreign tourists, and therefore the value of these units, at least in the short term, should be going down. Does it present maybe a buying opportunity for someone who is quite happy to live in the CBD area, always thought that the apartments were far too expensive because of the Airbnb rental values and all that sort of stuff? Is there going to be a potentially some reasonable value over the next year or so until the tourists and students come back?
Well, yes, with a caveat. I think for first home buyers, it's becoming relatively tempting. So again, Riskwise showed the buy versus rent equation. Now, almost across the country, it's cheaper to service a mortgage than it is to rent, at least from an interest cost perspective. I think if you were paying back the principal in Sydney and Melbourne, it would be a slightly different story. But so I think for a lot of first home buyers, and that's certainly the info and the intel we're getting, people have been sitting on the sidelines and now saying, well, it's cheaper to buy some of these units than it is to rent, so why not? I think from an investment perspective or from a capital growth perspective, you just got to be a little bit careful. High strata fees can be a risk. I think sometimes in some of the larger developments, there's a bit of a lack of scarcity in the product. So if you're looking for price growth, you generally get that more in the more boutique developments and more established developments where you get a bit more land value. The land to asset ratio is a bit higher. I think sometimes, particularly we've seen this in Brisbane CBD, some of these very large developments have really swamped the market in the CBD. So need to be a little bit careful there, I would say.
Okay. And what about the fact that because of the coronavirus, people are sort of tempted to move out from the inner ring around CBD because they might be able to work from home, going forward? Are we starting to see a demand for houses in outer areas that weren't as popular, say, a year or so ago?
Oh, absolutely. Yeah. I mean, it's interesting because I've long been a believer in the primacy of the big capital cities. And if you think about the big mega trend over the 10,000 years since humans domesticated wheat, it's just been towards larger and larger conurbations. But I would have to say this year we've seen a very big shift to tree change and sea change locations. Some of those areas where stock is naturally lower anyway, its prices are really rocketing. I think the research shows that if you look over 5 years, the coastal locations have done better than tree change. I think probably again because of the scarcity, and water is such a big draw card in Australian property. But the big performers over 5 years have been Noosa Heads, Kingscliff, Lennox Head, probably down your way, the Central Coast, a number of regions around Terrigal. So it's definitely happening this year. There's been a huge shift. I think the tree change locations, there's more choice, and some parts of regional Victoria and Tasmania have done well, but it's largely the coastal regions that have taken off. Yeah.
All right, one last question I'd love to throw at you. Given that delightful English accent you've got, do the Poms have the same attitude towards property as we do? Like, I think some of us would sell our grandmother into captivity to keep our house. And judging from the English television shows, with Christie and whatever his name, Phil, selling houses. Is it selling houses? Selling houses Australia? No, location. You Brits seem to be so keen on property. Or Australia's quite unique?
It's a little bit different in Britain. So certainly home ownership is very much aspired towards in Britain. So that is the same across those Anglo countries. I think the property investor dynamic is different. There's more institutional investing in the UK. There's also a great deal of social housing in the UK, much more so than in Australia. So naturally you get more in inverted commas, mum and dad investors in Australia. Is partly due to the tax system as well. But in London, build to rent has really taken off. There's a lot more institutional and large landlords. That's less common in Australia. It's more of a, for want of a better phrase, cottage industry. But it's very popular for people outside of their super. As you mentioned, a few quality companies in a rental property. That's a very typical scenario in Australia. Probably a bit less common in the UK for individuals to aspire to be a landlord.
Okay, so Pete, if people want to know more about your operation, what's the website?
Well, it's buyersbuyers.com.au. I think that should help people to find it as well. But yeah, as I mentioned, very good if you're looking for an affordable property buying service, because often it's been out of reach for first home buyers historically. So we've looked to address that.
Okay, great stuff. Thanks for joining us.
Pleasure. Cheers, Peter.
Well, it's budget time, and a sector that's been really hoping for something good out of the budget is, of course, the building sector. So we've got the CEO of the Master Builders Association, Danita Warren, on the program. Hi, Danita.
Good morning.
Now, Danita, you actually said in one of your press releases that you wanted this budget and the performance of the Treasury to be best on ground. Was it a best on ground performance?
It was pretty close. While the industry would have liked to have seen a little bit more support for the commercial building sector, it exceeded our expectations in terms of creating business confidence, which we in turn hope will result in greater investment by the industries around the country in capital works.
Okay, so what are the big wins specifically for builders?
The big wins from a residential builder's perspective is undoubtedly the First Home Owners Grant that builds upon the Home Builder program and its focus on new builds. That's a significant win for residential. Obviously, civil infrastructure has had some big wins in terms of bringing forward infrastructure expenditure, both in terms of small projects, including roads, right through to those big, large infrastructure projects, and ensuring that we've got significant business confidence throughout the economy. We hope in turn will ensure that there is more spending on commercial building work. There are some concerns, however, about population. If we don't have population growth, we know the negative impact that has on us in terms of the medium term.
Now, there are people out there, Danita, would say, yeah, we know population is really important, but do the sort of the arrival of lots of immigrants get in the way of first home buyers who have been, negatively affected by the whole property boom events of the last, say, decade? Are we seeing more first home buyers at least filling up some of the gap that's been left by a lack of immigrants?
That's absolutely right. We're seeing a huge number of first home buyers. Speaking to the banking sector this week, their members are saying they have not seen so many first home buyers come out and seek loans for a home. So you're right, in the short term, while we're having negative population growth, we will see some increase in home ownership and as a consequence more building occurring. But nevertheless, we know to the medium long term, population drivers are really the engine room of economic growth in this country.
Yeah. Another implication of the coronavirus, which of course is part of the reason why the building industry is in trouble at the moment, is because one of the developments is that according to demographers like Bernard Salt, that a lot of people want to move out away from the centre of big cities. And I would have thought that would have been a good thing for your constituency, because new homes invariably are in the outer rings of cities. Are we seeing a lot of new interest in locations that maybe weren't as popular 4 or 5 years ago?
That is totally correct, Peter. We're seeing significant uptake on land that was available for building, that had been sitting idle, that have been snapped up very quickly since Home Builder came into effect. And we're seeing a lot of interest in those smaller capital cities and the larger regional cities. So undoubtedly our members in those locations will have some benefit from that, and we're seeing that already, and in terms of that residential building, and we hope in turn that would assist in other building in those areas where there is an increase in population. So it's going to be interesting to see the domestic migration and policy shifts over the next 12 months.
Tell me, what kind of numbers of sort of new residential homes represent a healthy industry, and where are you guys at the moment?
So pre-COVID, we knew we had to build around about 200,000 homes each year for the next 10 years to meet that population of 30 million by 2030. And we were building around about 180,000 homes per year up until COVID. We've estimated that this financial year will probably build around about 125,000 homes. So that's significantly short than what we'd initially anticipated for this financial year. So we won't have that population growth in the short to medium term, but we do think in the long term we need to continue to build around about 180 to 200,000 homes for the next decade to ensure we can house everyone in the future. So we're still well short, Peter.
Yeah, so let's use 180 as a good benchmark, figuring at 125. Is the fact it's 125 all because of demand, or are there some supply and bottleneck problems in there as well?
Unfortunately, supply bottlenecks are still continuing, and it's been the biggest bane for all of us, including first home buyers, and it's a consequence of the significant prices that first home buyers are facing is around supply bottlenecks. In some cities, we simply don't have enough titled land to meet demand, and that's particularly prevalent in cities like Perth and Hobart at the moment. And we also see increasing costs of developer charges. So this is something that's a responsibility of the state governments to really reconsider their planning and their land release proposals in terms of ensuring we can meet those demands in the future.
Okay, now I'm prepared to be publicly shown to have been wrong, but and I hope I'm not wrong, but I have read and I've written in the past that a lot of the costs that first home buyers and other new home buyers have to pay, about a third of that cost are government charges. Is that a fair figure, or is it a bit exaggerated?
Possibly a little bit exaggerated, Peter, but you're not far off it. We know that the housing costs generally have stayed fairly stable, where the costs of government charges and right through from local government to state government and also things such as federal government taxes and so forth, all adds up in terms of the cost of building and constructing a new home. And so we'd like to see if there's any consideration of structural reform that state governments are considering in particular, that we're looking at decreasing those costs. And I mean, a classic at the moment is that switch between stamp duty and land taxes. And that is something that needs to be considered so we can even out the rates that are being applied for homeowners, so the first homeowners in particular aren't hit as they're entering into the market.
And one final question then, Danita, if we can see government actions that helps the increase of supply of properties, is that going to have a very substantial impact on the prices that people pay?
Well, we would hope in those cities where there's simply not enough titled land that it would even out those prices. And that's the big issue at the moment. We need that constant supply around the country of land so we don't have those price spikes that have happened in the past. As you quite rightly said earlier, the decline in population will mean that they perhaps won't occur in the short term, but we need to look at this in more of the medium to long term as well.
Danita, thanks for joining us on the show.
Absolute pleasure.
Before I go, Switzer Financial Group is pleased to bring you the virtual Switzer Investor Strategy Day on Tuesday the 20th and Wednesday the 21st of October. Held virtually via Zoom and hosted by myself, the two-day conference will give investors access and insight from some of Australia's best investors and fund managers. You'll have an opportunity to hear from these top fund managers to understand how they are investing in these unprecedented times. The day will deliver information through idea-driven educational sessions from the fund managers who share insights on how they are investing and what their thoughts are on the future. These sessions will be followed by a roundtable panel discussion. The audience will also have an opportunity to ask questions via Zoom to get a deeper understanding of how these experts are investing. I'm also very pleased to announce that we will also be joined on the day by the Treasurer of Australia, the Honourable Josh Frydenberg. He will be sharing his plans and insights into how he's going to lead us out of this recession. Click on this link in this video description below to register. It's going to be a great day, and I hope you can join us on Tuesday the 20th and Wednesday the 21st of October. See you next week.